welcome back to our YouTube channel. Our topic for today is commodity price hedging using FCPO. Now this topic looks like is only related to those consumer and producer of CPO, but actually this topic is relevant for both, even retailers and also consumer and producer of CPO itself. Now first, coming from retail perspective, we thought that futures is a zero-sum game, but is this true or not? Is it a zero-sum game? Sometimes it might look like the player of the investor in CPO futures itself is losing money in the futures market itself, but actually from the other market, maybe it can be a physical market, they're actually making money from the physical market itself. So although it is a zero-sum game in futures itself, but it doesn't mean that this is a zero-sum game as an overall, especially for the CPO producer and also CPO commercial user. So this is the topic that we are going to cover. I know that this is a very big topic itself, but it's very important for me to cover this topic because from retail perspective, we need to understand who is our competitors and what are they going to use, or what are the users in this CPO futures itself. From the consumer and producer perspective, we need to understand right now, nowadays, especially in terms of hedging, it's very important for us to hedge against our CPO. It doesn't matter we are producer or if we are a commercial user, because nowadays CPO prices fluctuation is very high. Unlike you can see that prior to like 2022, on average our CPO price fluctuation is between 50 to 100 max ringgit Malaysia per metric tons. But you can see that suddenly in 2022 our average fluctuation of CPO went up as high as 400 ringgit Malaysia per metric tons. That's the reason why nowadays it's very important for us to hedge against our crude palm oil. So without further ado, let me start with the topics as usual. If this is your first video, please remember to subscribe to our YouTube channels and on your notification bell. My name is Ting Ting. Now I need to start with a disclaimer. Today's session is only meant for education purposes. There's no buy or sell call. And if you're going to start with your hedging, try to seek your hedging consultant before you start your whole hedging process, because hedging is very customized. It doesn't mean that today if this company itself, I'm going to use this hedging template, it can be applied for the rest of the company as well, because every companies will be very much different. There's no template across the board that you can use. So it's very important for you to seek your individual hedging consultant to customize the hedging strategies for your own companies itself. Now, before we really start hedging, we need to understand the concept about hedging. What is the definition of hedging? But I'm going to use it in a layman perspective for you to understand, because I know that this hedging topic is very big, but I will try to summarize and give you the overview about the hedging itself. So in terms of a daily life, do you notice that actually we are involving in hedging, indirectly involving hedging? Like for example, today you are going to buy an insurance for your car itself, or you're going to buy an insurance for your house. So why we are going to buy insurance for our house or our car technically is to protect our downside risk. Can you see that? Technically is to protect your risk. It doesn't matter which part, we just need to protect our risk itself. So let's say for example, if I buy insurance for my car, I'm worried that there's a damage to my car itself, so I can claim from insurance to reduce the losses that I need to suffer. So the concept about hedging is similar. How can we hedge so that we can protect some things that we wanted to protect against? So this is the whole concept about hedging. So let us start with the concept about hedging, but before that, let us understand two main forces that affects market price. We need to understand this to understand that actually if you are a supplier or you are the person that's going to use CPO, definitely the method that you are going to use for your hedging will be very much different. So later I'm going to go into details, but before that, let us understand what are the two main forces that affects the market price. One is about demand and one is about supply, definitely. So let's say, for example, in terms of your supply side is those producers. So when you produce, let's say you are plantation owners, you produce CPO, you need to sell it. And for those demand, it's like those commercial user, those commercial who need to refine the CPO so that, let's say for example, they can use it to do or to sell the cooking oil, for example, or even to make soap, etc. So we need to understand that there are two main forces, and definitely these two main forces for supplier and those from demand perspective, the way for you to do your hedging will be very much different. Now, the next part that we need to understand is you can see that nowadays market fluctuation is really very high. You can see this happens in less than 3 months. Our FCPO actually dropped 3,100. 3,100 in less than 3 months per metric tons. So technically, there is 50% of reduction in terms of CPO prices. You can see the volatility is definitely high. There's a reason why I told you, if you really do a lot of research in terms of the market volatility prior to 2021 or even prior to 2020, previously our market fluctuation is within 50 to 100 ringgit Malaysia per metric tons, but suddenly, especially in the year of 2020, 2021, 2022, our average CPO went out as high as 400 ringgit Malaysia per metric tons. So that's the reason why we really need to look into the requirements, and we really need to start with this hedging itself. Especially, it doesn't matter you are the commercial part or you are coming from a producer part in terms of CPO. Now, how do you hedge? I'm going to give you an example from the perspective of producer because we are going to take one part of it only. If not, that's impossible for us to cover every areas of it. So we have technically two different products and two different markets. One is your crude palm oil, which is you're transacting in the physical market. Another one is your crude palm oil futures, which you are transacting in the futures market itself. So these two, technically CPO is derived from crude palm oil. So in short, without CPO, that's impossible that we can have crude palm oil futures product. So any products can be a futures product. It's like, for example, if one day, right, there's a lot of user iPhone, maybe they have this iPhone futures market as well, or iPhone futures products as well. So technically, this is like the mother and this is like the son. So the characteristic of the mothers will influence or will affect the son as well. So let's say, for example, if my mom is a very hot-tempered person, I might inherit the hot temper as well. So technically, you can see that if CPO market going higher, the price is going higher, what is your expectation of crude palm oil futures market as well? Definitely the same direction, right? Technically, they will be the same direction because this CPO futures is derived from the underlying, which is the crude palm oil itself. So let's say, for example, when the market dropped, and what is the expectation for crude palm oil futures as well? The same direction. It will be reduced as well. So, for example, if our crude palm oil, we lost 2,000 per metric tons, our CPO futures itself, what we can do is we can sell FCPO. So when you sold your FCPO futures contract, technically when the market drops, you can make money. So indirectly, this can neutralize that. So the concept about hedging is nothing to do with about making money. That's the secondary part. But actually, the primary objective for you to do hedging is actually to protect your risk. So you can neutralize it, or at least you can reduce your risk. Now, how do you do a hedging? I give you a very simple explanation, a very simple calculation, a very simple formula as well. So the number of contracts that you need to hedge, as It can be as simple as you're using the, let's say for example, the forecasted supply of your crude palm oil in metric tons divided by 25 metric tons. Why 25 metric tons? Is because per futures, FCPO futures contract is equivalent to 25 metric tons, meaning every contract their requirement is 25 metric tons. So with that, if you are going to take a calculation, let's say you have a forecasted expected supply is 25,000. So you are going to insert the figures 25,000 metric tons divided by 25 metric tons. So technically, you're going to see 1,000 contracts that you need to hedge against 25 metric tons. But actually, I'm not going to complicate this example. I give you a very simple. Normally, we don't fully hedge when it comes to CPO itself. So technically, if I'm going to give a very small figures, like let's say if I'm going to hedge 10%, 10% of what we are going to expect, then your 1,000 contract becomes only 100 contract. If you assume 10% of hedge ratio. So this is the most simplest way for us to calculate. Definitely, every companies will be very different from the rest of the companies, but generally this will be your understanding. And when it comes to hedging, actually we have two types of hedging. One we call it as long hedge, another one we call it as short hedge. So from the terms itself, you can see that long hedge meaning you are taking a long position. So long as you are the person that initiate a long position, technically when you are doing hedging, you are being categorized as long hedge. And if you are taking a short position, you are a short hedge. Now, what is the difference between long hedge and short hedge? Still remember the demand and the supply. So if you are a person that you falls under the category of demand, or you fall under a category of supplies, definitely your position of hedging will be different. So it depends. So let's say, for example, if you are a producer, so let's say you are farmers, you are plantation owners, etc. So you need to short hedge to protect your CPO itself, because technically it's very easy for us to understand. If you are a seller, any price drop in the market is going to affect you. That's the time that you need to hedge your CPO itself. If you need to hedge, if the market start to drop, meaning you need to start by hedging at a higher level, meaning you are going to initiate a short position. Now, another part that we need to understand is if you are a commercial user in terms of CPO. So you require the raw material to produce it, to come up with the end products, then technically you're a long hedge because you need to buy the CPO. So prices, if let's say for example, if the price going higher, it will be a risk for you, meaning at the low part you need to long your position to hedge against the CPO price, then you are a long hedge. You're going to have a long hedge position. Now, let's look at the last part about the advantages and motivators for hedging itself. Definitely, when you do your hedging, you will get a price certainty. So you are not going to worry in terms of the market fluctuation. As I mentioned before, nowadays the market price fluctuation is really very high. So once you hedge it, you can confirm the price that you are going to buy or you are going to sell. So it will give you a price certainty. As simple as that. So we need to understand nowadays really is very important for us to do our hedging. And if you really look at the industry itself, if in terms of those listed companies, in terms of the plantation sectors, top 5 companies, all of them they hedge. So sometimes if we look at those competitors or our industry players, if other people they are doing the hedging, is it a must for us to really reconsider? Should we do this hedging as well? If this is not a must, why other people they are doing that? Or our leaders in the industry itself, why are they doing that? So this is the first part. And second part is definitely in terms of your bottom line. So let's say for example, when you do your hedging, in terms of your bottom line, is definitely confirm. So at the end of the day, when we do our hedging, also we are going to protect our bottom line as well. So this is the part that we need to really understand why we really need to go with this hedging itself. Actually, I have many other advantages, but as a start, for you to really understand, this is very important part for you to understand. And not only that, we can give the certainties in terms of our planning. We can easily plan or budget or when we do our budgeting for our companies itself. So these are all the important points that I'm going to highlight to you. The importance for you to do your hedging. From retail perspective, you really need to understand that this is another type of investors or players or user in the futures market itself. So don't worry that it doesn't mean that when other people they are making money or other people that they are making money, we are losing money. So if you can understand that actually there are other users in the futures market itself, then you don't need to worry too much. And from producer and commercial user perspective, we really need to understand it's very important for us to do hedging so that, like for example, these two main reasons for us, like for example, price certainty is very important for us to govern our whole bottom line for our company itself. So I hope that this particular topics helps you. So I'm going to see you in our next video, and please consult your consultant, your hedging consultant, before you proceed. And remember to subscribe to our YouTube channels and on your notification bell. My name is Ting Ting. I'm going to see you in our next video. Bye bye.